Can a managing director legally draw 50 crore rupees as salary? Can a company that has made a loss still pay crores of remuneration to its directors? Can an independent director receive stock options? Can a listed company pay remuneration to a non-executive director without shareholder approval? Can sitting fees be paid without obtaining shareholders' approval? If one non-executive director receives more than 50% of the total remuneration payable to all non-executive directors, is an ordinary resolution enough? Can a listed company grant unlimited stock options to its non-executive directors? And here's the question that even many professionals get wrong. If a listed company pays remuneration without complying with SEBI LODR, is complying with Section 197 alone enough? The answer may surprise you. These are not just interview questions. These are favorite questions in CS Executive, CS Professional, CA and CMA examinations, and they are among the most common compliance mistakes made in listed companies. If you're preparing for professional exams or working as a company secretary, compliance officer, director, CFO, legal professional, or auditor, this is one video you simply cannot afford to miss. Hello everyone, welcome back to Corporate and Securities Law Compass. Today we are going to decode Section 197 of the Companies Act 2013, but with a practical twist. Because in the real corporate world, knowing Section 197 alone is not enough. If your company is listed, you must also comply with Regulation 17(6) of the SEBI LODR regulations. And this is exactly where many students lose marks and many listed companies make costly compliance mistakes. So today, instead of simply reading the bare provisions, we're going to understand how the Companies Act and SEBI LODR work together. By the end of this session, you'll have complete clarity on the 11% overall managerial remuneration limit, the magic numbers every student must remember: 5%, 10%, 1%, and 3%. Whether a company with no profits or inadequate profits can still pay remuneration, when an ordinary resolution is enough, and when a special resolution becomes mandatory. What happens if a director receives remuneration beyond the statutory limit? And that's not all. We'll also master Regulation 17(6) of the SEBI LODR regulations, including shareholder approval, sitting fees, stock options, and the 50% remuneration rule. Stay till the end because I'll also share an exam memory trick that helps you remember every important percentage under Section 197 and every key requirement under Regulation 17(6) in less than 2 minutes. If you remember that one trick, you'll be able to answer MCQs, descriptive questions, interviews, and practical compliance questions with confidence. Let's begin. Have you noticed something interesting? Section 197 tells you the limit, but it never tells you what exactly is included in remuneration. And it never tells you which profit you should use. That is where most students lose marks. Let me make it crystal clear. First, understand the meaning of total managerial remuneration. It includes remuneration paid to the managing director, whole-time director, manager, and all other directors, whether executive, non-executive, or independent directors, wherever remuneration is payable. But that's not all. Remuneration is much more than just salary. It includes salary, commission, bonus, perquisites, allowances, performance incentives, and even the monetary value of benefits. So in the exam, whenever you see the words total managerial remuneration, think about every form of payment made to managerial personnel. Now comes the biggest exam trap. Most students calculate the 11% limit using the profit after tax shown in the financial statements. That is absolutely wrong. The Companies Act says the 11% limit must be calculated on the net profit computed under Section 198. Remember this forever. Section 197 tells you the limit. Section 198 tells you how to calculate the profit. One section gives the ceiling, the other section gives the calculation. And now comes the question that examiners love. Should directors' remuneration be deducted while calculating the net profit under Section 198? The answer is no. Directors' remuneration shall not be deducted from the gross profits while computing the net profit for this purpose. Many students deduct it and end up calculating a lower limit. That is one of the most common mistakes in company law exams. So remember this simple formula. Total remuneration means every payment to managerial personnel. Section 198 calculates the profit. Section 197 applies the 11% limit. And director's remuneration is never deducted while computing that profit. If you remember these 4 points, you can confidently answer almost every basic question on Section 197. Have you noticed something interesting? Section 197 tells you the limit, but it never tells you what exactly is included in remuneration. And it never tells you which profit you should use. That is where most students lose marks. Let me make it crystal clear. First, understand the meaning of total managerial remuneration. It includes remuneration paid to the managing director, whole-time director, manager, and all other directors, whether executive, non-executive, or independent directors, wherever remuneration is payable. But that's not all. Remuneration is much more than just salary. It includes salary, commission, bonus, perquisites, allowances, performance incentives, and even the monetary value of benefits. So in the exam, whenever you see the words total managerial remuneration, think about every form of payment made to managerial personnel. Now comes the biggest exam trap. Most students calculate the 11% limit using the profit after tax shown in the financial statements. That is absolutely wrong. The Companies Act says the 11% limit must be calculated on the net profit computed under Section 198. Remember this forever. Section 197 tells you the limit. Section 198 tells you how to calculate the profit. One section gives the ceiling, the other section gives the calculation. And now comes the question that examiners love. Should directors' remuneration be deducted while calculating the net profit under Section 198? The answer is no. Directors' remuneration shall not be deducted from the gross profits while computing the net profit for this purpose. Many students deduct it and end up calculating a lower limit. That is one of the most common mistakes in company law exams. So remember this simple formula. Total remuneration means every payment to managerial personnel. Section 198 calculates the profit. Section 197 applies the 11% limit. And directors' remuneration is never deducted while computing that profit. If you remember these 4 points, you can confidently answer almost every basic question on Section 197. Have you ever wondered, why does the Companies Act clearly say that directors' remuneration should not be deducted while calculating the 11% limit? There is one simple reason, and once you understand it, you will never forget this provision. Let's see. Imagine a company has a gross profit of 100 crore. It has already paid directors' remuneration of 8 crore. Now many students make this calculation. They deduct 8 crore from 100 crore. That leaves a profit of 92 crore. Then they calculate 11% on 92 crore. That comes to 10.12 crore. Sounds logical. But this entire calculation is wrong. The Companies Act specifically prohibits this deduction. Now the question is, why? Because if directors' remuneration is deducted first, the profit becomes smaller. And when the profit becomes smaller, the maximum remuneration limit also becomes smaller. This creates a circular calculation. Think about it. You are using directors' remuneration to reduce the profit. Then using that reduced profit to calculate the limit of directors' remuneration. The answer keeps changing. The law does not allow this confusion. That is why the Companies Act clearly says, do not deduct directors' remuneration while calculating the net profit under Section 198. Instead, calculate the net profit first under Section 198. Then apply the 11% limit under Section 197. Remember this exam formula forever. First calculate the profit, then calculate the limit. Never reduce the profit by directors' remuneration. If you remember this one concept, you can avoid one of the most common mistakes in company law examinations. Now let's see the correct method that every examiner expects. Suppose a company has a gross profit of 100 crore. The company has already paid directors' remuneration of 8 crore. Should we deduct this 8 crore before calculating the 11% limit? The answer is no. The Companies Act clearly says do not deduct directors' remuneration while computing the net profit under Section 198. So the net profit for calculating the limit remains 100 crore. Now calculate the maximum managerial remuneration. 100 crore multiplied by 11%. The answer is 11 crore. This is the correct calculation. Remember this golden rule. First calculate the net profit under Section 198. Then apply the 11% limit under Section 197. Never deduct directors' remuneration. Now let's solve one more exam question. Assume the net profit under Section 198 is 200 crore. The maximum managerial remuneration will be 11% of 200 crore. That comes to 22 crore. Now suppose the company proposes to pay remuneration of only 20 crore. Is the company complying with Section 197? Absolutely yes. Because the actual remuneration of 20 crore is below the maximum permissible limit of 22 crore. So there is no violation of Section 197. Remember this simple exam formula. Actual remuneration less than or equal to maximum permissible remuneration, complied. Actual remuneration more than maximum permissible remuneration. Check the provisos to Section 197. This simple comparison can help you answer almost every numerical question on managerial remuneration correctly. Now let's make the concept slightly more interesting. Suppose the company's net profit under Section 198 is 200 crore. The maximum managerial remuneration allowed under Section 197 will be 11%. That means the company can pay a maximum of 22 crore. But what if the board proposes remuneration of 26 crore? Can the company pay it? The answer is yes, but not automatically. This is where the first proviso to Section 197 comes into action. The company must first obtain approval from the members in the general meeting, and then it must comply with the provisions of Schedule 5. Only after satisfying both these conditions can the company legally pay remuneration beyond the 11% limit. Now let's connect this provision with a real company. Assume Tata Motors Limited has a net profit under Section 198 of 10,000 crore. The maximum managerial remuneration under Section 197 will be 11%. That comes to 1100 crore. Now suppose the total remuneration proposed for the managing director, executive directors and non-executive directors is only 950 crore. Is Tata Motors complying with Section 197? Absolutely yes. Because the proposed remuneration of 950 crore is well within the maximum permissible limit of 1100 crore. So there is no need to invoke the first proviso. No additional approval for exceeding the 11% ceiling is required because the company has not crossed the statutory limit. Now imagine Tata Motors' proposed remuneration of 1200 crore instead of 950 crore. Would it still be allowed? Yes, but only after obtaining members' approval in the general meeting and complying with Schedule 5. Remember this exam shortcut. Below the 11% limit means normal compliance. Above the 11% limit means first proviso comes into action. And never forget the two magic words. General meeting, Schedule 5. These two words can easily fetch you extra marks in company law examinations. Now let's finish this concept with one final practical example. Assume Tata Motors Limited has a net profit under Section 198 of 10,000 crore. The maximum managerial remuneration under Section 197 will be 11%. That comes to 1100 crore. Now suppose the company proposes total remuneration of 950 crore for its managing director, executive directors and non-executive directors. Is the company complying with the Companies Act? Yes, because 950 crore is below the maximum permissible limit of 1100 crore. So Tata Motors complies with Section 197. Now let's make this question a little more interesting. What if the company proposes remuneration of 1250 crore instead of 950 crore? Can it still pay that amount? Yes, but only after satisfying two important legal conditions. First, approval of the shareholders in the general meeting. Second, compliance with Schedule 5 of the Companies Act. Only after fulfilling both conditions can remuneration beyond the 11% limit become legally valid. Remember, the Tata Motors figures used here are only for understanding the law. They are purely illustrative and do not represent the company's actual remuneration. Now let's do a quick exam revision. Section 197 applies to public companies. The overall managerial remuneration cannot exceed 11% of the net profit. The net profit is calculated under Section 198. While calculating that profit, directors' remuneration is never deducted. The 11% limit applies to the total remuneration of the managing director, whole-time director, manager and other directors taken together. If remuneration exceeds 11%, the company must obtain shareholders' approval in the general meeting and comply with Schedule 5. Now remember this formula because it can save you marks in every company law exam. Section 198 calculates the profit. Section 197 applies the 11% limit. Never deduct director's remuneration. More than 11%. General meeting plus Schedule 5. If you can remember just these four lines, Section 197 becomes one of the easiest chapters in the Companies Act. Now let's understand the first proviso to Section 197(1). Many students think the 11% limit is absolute, but that's not true. The Companies Act itself provides an exception. The first proviso says that a company may pay managerial remuneration exceeding 11% of its net profits, but only if two conditions are fulfilled. First, The remuneration must be approved by the members in the general meeting. Second, the company must comply with Schedule 5 of the Companies Act. Remember this. General meeting approval alone is not enough. Schedule 5 compliance is also compulsory. Now let's understand with an example. Suppose the company's net profit under Section 198 is 100 crore. The maximum remuneration under Section 197 will be 11 crore. But the company wants to pay 14 crore. Can it do so? Yes, but only after obtaining members' approval in the general meeting and complying with Schedule 5. Now take another example. The net profit under Section 198 is 200 crore. The maximum permissible remuneration is 22 crore. If the company proposes remuneration of only 20 crore, is the first proviso required? No, because the remuneration is already within the statutory limit of 11%. So the normal provision applies. Now remember this simple exam formula. 11% is the general rule. More than 11%? General meeting approval plus Schedule 5. If you mention these two conditions in the examination, your answer on Section 197(1) will be complete and legally correct. We will understand the second proviso to Section 197(1) of the Companies Act 2013, one of the most important provisions for CS Executive, CS Professional Examinations, and Practical Corporate Compliance. Let me start with a simple question. If a company earns huge profits, can it pay any amount of remuneration to its managing director or independent directors? The answer is no. The Companies Act does not only prescribe an overall ceiling on managerial remuneration, it also prescribes separate limits for different categories of directors. Now let us understand the statutory provision. The second proviso to Section 197(1) provides that, except with the approval of the company in a general meeting by passing a special resolution, the following limits cannot be exceeded. First, let us discuss Clause 1. This clause applies to executive directors. Executive directors include a managing director, a whole-time director, and a manager. If the company has only one managing director, whole-time director, or manager, the remuneration payable to that person cannot exceed 5% of the company's net profits. However, if the company has more than one managing director, whole-time director, or manager, their combined remuneration cannot exceed 10% of the company's net profits. This is a very important examination point. One executive director means a maximum limit of 5%. More than one executive director means a combined maximum limit of 10%. Now let us move to Clause 2. This clause applies to directors who are neither managing directors nor whole-time directors. These are generally non-executive directors and independent directors. There are two situations under this clause. In the first situation, if the company has a managing director, whole-time director, or manager, the total remuneration payable to all non-executive directors together cannot exceed 1% of the company's net profits. In the second situation, if the company does not have a managing director, whole-time director, or manager, the limit increases to 3% of the company's net profits. Now let us understand the reason behind these different limits. Executive directors are responsible for managing the day-to-day operations of the company. They are involved in decision-making, business execution, and overall management. Therefore, the law permits comparatively higher remuneration. On the other hand, independent directors and other non-executive directors primarily perform supervisory and governance functions. They oversee the management but do not manage the daily affairs of the company. Therefore, the Act prescribes a comparatively lower remuneration limit for them. Let us understand this with a simple example. Suppose a company has net profits of 100 crore rupees and has only one managing director. The maximum remuneration payable to that managing director is 5 crore rupees under this provision. Similarly, if the company has a managing director along with independent directors, the combined remuneration payable to all the non-executive directors cannot exceed 1% of the net profits unless the required approval is obtained in accordance with the Companies Act. Before we conclude, here is a simple memory trick. One executive director equals 5%. More than one executive director equals 10%. Executive management exists equals 1% for non-executive directors. No executive management equals 3% for non-executive directors. Simply remember the sequence 5, 10, 1, and 3. This sequence will help you answer examination questions quickly and accurately. If you found this video helpful, please like the video, share it with your friends preparing for CS, CA, or CMA examinations, and subscribe to Corporate and Securities Law Compass for more detailed explanations on the Companies Act, SEBI regulations, and corporate law. Thank you for watching, and I will see you in the next video. That brings us to the end of our quick revision of Section 197 subsection 1 up to the third proviso. If you found this video helpful, please give it a like, share it with your friends and colleagues preparing for CA, CA and CMA examinations, and don't forget to subscribe to Corporate and Securities Law Compass. Also press the bell icon so that you never miss our upcoming videos on the Companies Act, SEBI regulations and practical corporate law. In the next video, we will continue with the remaining provisions of Section 197 and understand them with simple explanations, practical examples, and examination-oriented analysis. Thank you for watching, and I will see you in the next video.